Hello guys, welcome again to another session of our course Alliance. Today we are going to continue with the risk management and psychology course or lesson. We already done with risk management, but I'm still thinking we are going to host another session for mostly on discussions, right? So questions and answers on risk management. So today we are going to be talking about psychology, which is a very key factor in our trading. All right. So I'll just give you some theory and then it's like a discussion topic because this deals with who you are. Okay. It deals with your personality, who you are as a person, how disciplined you are. Okay. How patient you can be in things like that. So we are going to be talking about psychology today in this lesson. Right. So on the chat here, let me just be discussing while I'm here so that sometimes I'll be pointing out some things here on the charts for you. So our topics is psychology today, and that's the lesson that we are going to be talking about. So psychology here in trading is simply just how you react to the market or how you relate with the market, all right? The relationship you have with the market as a retail trader. Okay. And when we talk about psychology, there are some few things that we will be looking out for. Like once you talk about psychology, the first thing that comes to somebody's mind should be discipline. You need to be a disciplined trader. We are going to talk about it. The next one is patience. You need to be patient enough for your plans, or you need to be systematic in your trading. And then you talk about your emotions. Okay, your emotions. You talk about FOMO, which is fear, and greed. Those are the things that are mostly associated with psychology, okay, in trading. So we are going to be discussing mostly on how to handle these aspects, okay, how to handle these aspects. But I want you to understand that risk management, and psychology are very, very much close together, okay? It's like something is directly proportional to the other, right? Which means that if you have good risk management, there is a high probability that you're going to have a good psychology as concerns trading. Okay, that is very, very important. That is very, very important. If you have good risk management in place, then you are not going to suffer from psychology a lot. All right. I mean, you are going to treat this psychology just with a fingertip. So that's the reason why I first of all gave you a lesson on risk management so that if you are able if you're able to grab the secrets about risk management, if you're able to enforce risk management in your day-to-day trades, then psychology is not going to be a problem for you. Okay. It's not going to be a problem for you. Now, remember, I said it's directly proportional to the other, which means that risk management equals to psychology and psychology is equal to risk management. Now, in another sense, if you have good psychology, risk management is not going to be a problem for you. So you get the point now. So it's like this one is going with this one, and this one is still going with this one. So they're like directly proportional to each other. If you have good psychology, you will not suffer with risk management. Let me just give a quick sample. Let's say you know that okay, as you're entering this trade, it might work out or it might not work out, right? That's already a good thought that you have in your mind. So once you have that thought, coming to your risk management, you're not going to use 1,000 lots, right? You're going to use the smallest lot with respect to your account size. All right. So having that mindset here on the window of psychology already helped you on how to choose a good risk management position size. All right. Now, using this the lowest position size in this particular trade will help you not to be you'll be emotionless about the trade. You will not be afraid of the trade, and then you will not be greedy because I mean there will be no reason for you to be greedy, right? And you'll be patient enough because actually not your life, not your life funds, or how do I put it, not your life earnings are on a single trade. You understand? So these two things are directly proportional to each other. It's very important that you pay good attention to risk management and psychology as well. So I'll just be discussing, make sure you're writing down things that I'll be talking about, because I'm discussing, I'll be giving some facts, making some statements that will help you a lot, right? It will help you a lot. So let's just start. Let me just start with the first thing. Remember, today we are talking about psychology. So our main focus is here on psychology, discipline, patience, your emotions, fear, and so on. Because I've discovered that sometimes you can actually have a good trade, but you'll be afraid to take the trade. All right, you'll be afraid to take the trade. Now, I believe that with all the lessons that I have given to you, 99% of you knew that this is likely going to buy from this BC, right? But how many of us took the trade? How many of us enter at the 50% of this trade and put our take profit here? I mean, you will likely see that no one, right? But that's because we are either afraid, we are not patient. That is, we don't have a good mindset towards this, right? But now, for example, somebody might have entered here like I did with a big lot, right? With a big lot size. And when the market gets up to a certain level, you are already satisfied with what you have. That's not a problem. That's treating the part of greed, okay? That's treating with the part of greed. Now, if you enter here and before the close of the day, you are already on good profits, it's good to pay yourself, right? As a trader, always pay yourself. You don't have to be greedy. Anything can happen. Price can actually react to this level, go up, react to this other block, and then goes back down, right? Meanwhile, you were in deep profits and just to close at break even or something. So it's actually always good to pay yourself, right? Now, paying yourself is in stages. You can pay yourself, and yet you close your position size in partials, right? Let's say I enter here with 100, one standard lot, all right? Now, when prices come to a certain level, I can now close 0.90 of this trade, can now close 0.90 and leave 0.10, okay, on this trade, and now put my stop loss at break even. Now, this is like free money to me. Okay, it's like free money that will run to my TP. I've already paid myself with 0.90 lot, and that's huge, right? So leaving this small one to run through, I'm not greedy anymore, right? I'm not greedy. I've paid myself already. Now I'm saying that, okay, if the market wants to come back to break even, fine. If it doesn't, I mean, this is free money, right? It's already free money. So those are the things that we put into consideration when you are trading, okay? How to deal with greed is that once you enter a position, once you are in profit, right? Let's say you are in an uptrend and then you are targeting this high. So you enter a buy at this level. Immediately the market takes this high, you should be taking off at least 80% of your profits, right? That's not being greedy, like leaving all the positions thinking that it will go right up to this level. Okay. Sometimes it can come up to this level, drop back down, and then things like that. So being greedy, at least where the next liquidity zone is, you clear off your 80%, you pay yourself, and then if something is left in the market at that point, if something is left, like the least percent, yeah, it could be like free money now for you to run to your take profit. But immediately you see price at a liquidity zone, you close partial, because price might actually clear stops here, come back to clear the internal range liquidity. So that's just about greed, okay? So about discipline here is simply just to follow a plan, all right? You should be disciplined enough to trade systematically, which means that with your risk management, you should be disciplined enough to follow your risk management. If you are to enter trades with this position size systematically, let it be so, all right? Throughout your trading of that particular account, okay? Now, being patient is simply like it's still about your plan, how you want to enter a trade. Now, suppose that let's say normally I wanted to enter this trade here. Sometimes your price can come and reach at a level like this, like it did here, and then you see it start like it wants to buy back. Some people will enter here. So you are not patient enough. Actually, you spotted this as your zone of buying, but price hasn't reached there yet, and you are already buying, right? You are not being patient enough to wait for price at your take profit. I mean at your entry zones, right? You are not being patient enough. Now, with emotions, emotions most of the time comes in when you over leverage or you use high lot size, which is not the right thing to do. Okay, it's not the right thing to do. How to kill emotions is basically you have to limit your lots, limit your position sizing. Okay, why are you limiting your position sizing? You are doing this because you don't know the outcome of the trade that you want to enter at the moment. All right. So if you don't know the outcome of the trade you are entering at the moment, why should you use a heavy lot size? There is no reason. Why should you use a big position size? There is no reasons. And immediately use a big position size, you put your emotions to work. You start to be afraid. If you lose this now, your account is going to be blown up. That's not the right thing to do. Okay. It's not the right thing to do. There is no way that you will ever hear someone say, okay, all this while I have been able to use the smallest lot size, small losses, big wins, and then they say the account has been blown. It's not possible, right? Unless you had a very small account that's a 0.01 lot can blow it with, I mean, $5 account and all those things. Okay, so those are the things that we put into consideration. So now let's start. How to build up your psychology as a trader, or how to trade like a successful trader or like a profitable and consistent trader. You have to build your expectations, right? You have to work on your expectations. The fact that a trade worked at this CB doesn't mean that the next CB trade is going to play out the same, right? So your expectations on a particular setup should be limited, right? You should not expect 100% from any setup that is happening at any moment. Okay. Now, normally, let's just go back a little bit here. Okay. Now, looking at this point, we had there is a small CB here, right? There's a small CB here. Now, this is one thing I said again. When you look at this BC here, price reacted right down to the center with the consequent encroachment. But at this point, look at the CB from the BC from here, right down. So price came right down to this other block. So these are the things that will make you understand that every price delivery at a certain time is unique. Okay, it's not like okay, since price came down to this other block here, this same thing again is going to come right down to this other block, but it reacted here. So that's why you need to be systematic in your trading. Your expectations should not be like you are the one controlling the market. Okay, you trade what you see in the market, you trade what the market tells you. Okay, you don't create your own price action in the market. You don't force the market. The market will go where it wants to go, despite whatever other blocks or fair value gaps that you are seeing. All right. The only thing to help you is work with the market. All right. If it shows you willingness to drop to the other block, follow it. It's going to show you willingness to go back up for the external range liquidity. You follow it. It drops back down to the fair value gap, shows you willingness to go back up to the external range liquidity. You go with it, as simple as that. You follow the market where it's going to. You barely have nothing in the market to like control it, right? You don't have anything to control the market with your account size, all those things. They are insignificant in the market. Okay, which means that the market is definitely going to go anywhere it wants to go. So the only thing for you to do is forget about your expectations. Know that the market has to go where it wants to go. So your expectations should be completely null and void, right? Don't expect a trade to work 100%. Normally, they are high probability trades, but when you want to trade a high probability trade, you still have to use good risk management, okay, which are aligned with so much confluences. You still have to use good risk management. So expectations is very, very important. Don't let your expectations make you to pour out all your accounts on a single position. All right. So despite the fact that something work like this in the near future, it might not work the same. It might not work the same. Okay. So those are the things that you have to consider. If this position, if it works now, this works, this did as well, but we saw here sometime this fair value gap did not work. Price came back to this other block. So these things like this, as I'm explaining, I just want to make you understand that price delivery is unique. There is a level of uncertainty in the market that just analysis cannot fully dispel, right? So which means that no matter how good you do your analysis, there is still that element of uncertainties. That's no matter how good your analysis are, you cannot clear, you cannot dispel, or you cannot kill the uncertainties, right? It's still going to be there. You cannot know the future. Okay, you don't know the future, right? It's as simple as that. You don't know the future. You don't know the outcome of their next trade, which means that in a short term, your positions, I mean, your trade outcomes are going to be randomly distributed, like McDonald's used to say. Okay, your position, I mean, your trades are going to be randomly distributed, your wins and losses. Okay, now when another factor, okay, let's just say, let me say that again. Let me say that again. In a short term, okay, short term, your trade outcomes are going to be randomly distributed. So you have to keep that in mind, that there is a level on uncertainty in the market that no matter how good your analysis is, it cannot dispel, right? Whether you do analysis, let them be good as what. Know that there is an element of uncertainty in the market that your analysis cannot fully dispel. Okay, if you know that, you are going to know peace. Okay, if you know that, you know peace. Now, sometimes you can get a string of losses, a string of wins, but the next trade that you want to take, know that this trade, that means if you have string of wins, let's say you have 10 winning strings or 10 losing strings, the 11 trade that you are going to take, still know that there's an uncertain outcome. All right. It doesn't mean that as you won 10 trades, the next 11 is going to be a winner. If you feel like the next 11 is going to be a winner, you're going to pour out all your account to it, which is not the right thing to do. Okay. So that uncertainty, probability, you need to have it, and you need to have that mindset, thinking in probability that, okay, I've lost 11 trades, right? The next one, it might work same as it might not work. That will make you to be consistently exposing yourself to the market. Okay, if you have losing trades like 10 and you give up, or you will start to be afraid that, okay, 11 is going to be another loser. No, that mindset is wrong. You don't know the outcome of the 11. It can be a win, same it might be a lose. So which means that you have to apply good risk management in that particular trade. So you cannot know the future. Now, like I say, an element of uncertainties that no analysis in the market can fully dispel. Okay, so what do professional traders really do? The main thing that they do is risk control, right? That's what separates professional traders with the rest of the traders. Professional risk control, intelligent risk control. Okay, you need to risk intelligently. You risk intelligently in the market. All right. So now, how do these people, I mean, professional traders, they do trade? All right. You see people making millions and so on. For a professional trader, they have a mindset that is, they have in mind that they have to be consistently exposed to the market, which means that they know that they're going to be trading long term, right? If you know that you're going to be trading long term, you try as much as possible to fight tomorrow. You don't fight all the battles today. Okay, the market will always be there. So you live to fight another day. If you don't eat today, you live to eat tomorrow. Okay. Now, if you don't eat today, which means that you're having a loss. If you don't eat today and you die, it's not really a good thing, right? If I haven't eaten today and I'm still alive, tomorrow I will look for work and then get something to do and I'll have something to eat. It's as simple as that. Okay, it's not like if you don't eat today, you go and commit suicide. It's not realistic. Why should you not eat today and you commit suicide? No, if I don't eat today, fine, I'm starving. Tomorrow I'll get some work. Maybe I'll get something to eat, I'll drink water and all those things. So you have to be consistently exposed to the market. Why? Because you are having this mindset that your trade idea, your trade outcomes is going to be with series of trades, right? You want to be consistently exposed to the market, which means that you normally, you know that you don't have 100% win rate, right? Which means that it's with a series of trades that you are going to see results. You don't measure your results in a single trade. You don't measure your results in two trades. It's with a series of trades. Okay. That's why you have to allow yourself to be exposed to the market, to be that is consistent exposure to the market every day. All right. Every day. That's what professional traders do. They're exposed to the market every day. Every day. You keep learning every day, playing the numbers game. You enter today. If it works, fine. If it doesn't, you enter again tomorrow, right? You live to fight another day. You live to eat another day and things like that. Okay. So to generate long-term results, you have to do an intelligent risk control. Okay. That's what consistent traders do. That's the edge that you need to have when it comes to psychology. You have to be consistent. All right. You should be exposed to the thoughtful risk management. Okay. You should be exposed to the market consistently with thoughtful risk management. All right. Every day you have to be exposed to the market. I mean, every day you are looking for a trade. When you see the trade that meets your criteria, you enter with thoughtful risk management, with intelligent risk control. All right. Knowing that there is still another tomorrow. You don't enter today with all your accounts and tomorrow you see a setup and you will not have anything to trade with. All right. So the market offers sometimes tremendous opportunities, which I mean almost every day, and some are so tempting that you want to enter with all your family earnings, right? That's a bad idea. Okay. You have to keep your position size has to be systematic. It has to be systematic. You need to calculate it. Like with this account, I'm going to be hitting 0.1, hitting 0.1, hitting 0.01, hitting 0. You should be systematic. Okay. You should be trading. You should have a systematic way of trading. All right. So, like I said, you have to live to fight another battles. There are battles that you're fighting day in and day out. You have to live to fight another day. Okay, live to fight other battles. Constantly watch your back. All right, you have to constantly watch your back. Constantly. It's going to that is, it should be a red flag for you to have a big loser. Right. So normally we have there are basically four outcomes of a trade, right? You should have a small loss. You should have a small loss, all right, or break even, small win, and a big win. These are the only expectations you should have in a trade. No, that is a red flag to big loss. All right. A red flag to big loss. Why? Because if you have this in your career, it's going to be a waste of time for you as a trader. All right. Because this big win is what changes everything here. You have to limit your big losses to small losses, right? Because now these small losses go with small wins, right? This break even is still zero. Okay. So small losses cancel small wins, and then big wins cancels nothing. So you are up with big wins, right? So if you put big losses again here, then you are just doing nothing. You are doing nothing, okay? So there should be red flag with you should not even think of big losses in your trading, all right? So a red flag to big losses, small losses, break even, small wins, and big wins, right? Like I said, small losses here. Like I said, small losses goes with cancels small wins, right? And then break even is 0, right? Which means that you enter the trade and you lock back you took back the profit. I mean, you lock the trade and you were risking nothing again. So price took you a break even, that's fine. You have a small win of $10 here. You have a small loss of $10, small win of $10. This cancels this, right? Then a big win now. This big win can be $100. So you are up $100. Even if you have small losses of like 20, 10, 10, $10, and then here you have one win, one break even, and you have a big win. That's what puts you ahead of other traders, okay? It's a series of trades that you measure your results, all right? So those are the 4 things that you should be expecting at any trade. No to big losses, okay? So when you have these small losses, break even, big wins, and small wins, then you are virtually guaranteed, all right? You are virtually guaranteed. I mean, your results are virtually guaranteed, or you are virtually guaranteed to see profitable results, to see consistent results, okay, as you go ahead with your trading, all right? If you keep these things intact, small losses, break even, small wins, and big wins, that is your profitability is guaranteed, all right? It's guaranteed. It's guaranteed. Now, this is as a result of risk to reward ratio, okay? Risk to reward ratio. Your risk should be small, your reward should be big. That is it, right? So now, like I said, big losses should be a red flag, all right? Keep your risk small relative to your account with a good risk to reward ratio, all right? Will help you to kill your emotions, okay? You will kill your emotions. If you use heavy lot sizes, you are going to be shivering in front of your trade. You see the market goes up, want to come back down, you're shivering, there's going to clear a stop loss because of what you were risking was too much. All right. Imagine that you have a $100 account, right? And you have a stop loss range of $1 and price wants to hit it. That will not even bother you because $1 is barely nothing in a $10 account, right? So you have like, if you're risking just $1 in every trade, you have like 100 trades to take before you can finally blow this account. And it's not possible that you can do that because each trade you are going to be risk trading, you are going to be risking $1 in return of 3 or at least 3, right? If you lose even 70 trades, 70 in $70 here, and you win just 30 times. That means inside this 100 times of trades that you're going to be taking, if you lose 70 of the time and you win just 30 of the time, you are going to be in big profits. Okay, you are still going to be in big profits. All right. So what I'm saying is risking little as compared to your account size will kill the emotions that we talked about at the beginning, right? It will help you to trade systematically without any emotions in play, right? So managing your risks, small losses, taking just small losses, no account can be blown with this method, right? Keeping your risks control as little as possible, as minimum as possible, right? So you have to be systematic in your position sizing. Like I said, if you have $100, know that okay, if you have seen a good trade setup here, if I want to enter this trade, you already know that you are going to be entering with 0.01. right? That's it. You are systematic. Even though the trade looks high probability as what, you are not going to be increasing the lot size to 0.1 ever, because you know that the outcome of this trade might likely work same as it might not work, right? You're thinking in probabilities. You have that mindset that the outcome of this trade is uncertain. It might not happen as you are expecting. Okay, it might not happen as you are expecting. So those are the things that you have to put into consideration when it comes to psychology. Okay, it's a very, very important topic. Very, very important topic. Okay, how to be disciplined too. It's a very, very broad topic when it comes to your personal life. All right, how to have self-discipline. Okay, building self-discipline takes some time. And if you are disciplined enough to, like, okay, these are the rules that you have put down for your training, you are going to follow them. You need to be someone that has self-discipline. Some so let's say some facts, some tips that you can use to build your self-discipline. You have to, create new habits. You have to create new habits, repeat the habits over and over. You tend to fall in love with them, and you tend to do them all the time. You have to develop new habits. Those are just some little things that you can do to build self-confidence. Okay, make journaling your lifestyle. That is, journal everything. All right, anything that you come across, you just journal it. Write things. Make writing a part of your lifestyle. Okay, you can do meditation. Meditation too is a very, very important thing to do. Okay, you get up in the morning, you meditate for 15 minutes, like it's for a starter. All right, just sit. If you have some kind of some sounds, right, some kind of meditation sounds, you can play them. Just sit, meditate, to think, right? Meditate, focus your mind on on particular things. Okay, meditation helps you a lot to, you also need to your self discipline. Okay, so you have to also to at least wake up early, things like that. Wake up early. You don't sleep like a pregnant woman. Okay, you have to be waking up early. So those are some things that you can practice if you want to you want self-discipline. Okay, and if these things are part of you, it's going to help you a lot in your trading career. Okay, it's going to help you a lot in your trading career. If you are an undisciplined person, trading is going to humble you, right? So waking up early, trying a new thing every day. Saving money, things like that, expressing gratitude of things that can happen to you, or you're grateful. Somebody learn to be grateful to people. Those are the things that will help you. Self-awareness. Okay, doing exercise daily. Those are that can go to the gym, can go those. Just do exercises to keep fit. It helps your psychology a lot, right? Helps you a lot. You think you can see most professional traders, most young professional traders, most nowadays, they like going to the gym, right? Get up in the morning, go to the gym, make sports, come back, you trade, you stroll around. Okay, so those are the things that can help contribute to having a strong mental health, having self-discipline, to be able to focus, meditate, right? Keep meditation part of your life. Keep journaling part of your life, like journaling your traits, journaling things that you want to do for the day. Practice writing them down. It will help you a lot. Being grateful to things that are done, that people do to you, or you should be grateful, right? You should be really, really grateful. Okay, those things, they're going to help you build a good mental health, right? So that is it for this psychology lesson. We are going to host, I'm going to give you a call on a session that we are going to discuss, right? We are going to discuss, then hear what you What are your main difficulties? And make sure that you write down everything that I've said here, put it down, right? Remember the last points that I gave. Make journaling a part of your life. So if you are watching this video and you don't yet have a book, you have to get one and restart watching back the video, journaling the key points that I'm mentioning, okay? The key points that I'm mentioning, making journaling part of your life, okay? Making journaling part of your life. You get up in the morning, you can sit. After a meditation, you think the things that you're supposed to do for the day, just write them down. At the end of the day, check to see how many have you got accomplished, why didn't you accomplish some, what made you do this and that, this and that. You went out of context, why happened. When you do like that, it helps you build a strong mental, it makes you self-discipline, okay? So those things, they help a lot, right? Make journaling parts of your life, right? Remember, like I said, risk management and psychology they're like brothers. They're indirectly proportional to each other, which means that with good risk management, your psychology is going to be perfect. Okay. You are not going to be trading with emotions. You are not going to be impatient. All right. You are using professional risk management. Okay. Your risk control is 100%. Now, if you have good psychology as well, then you are not going to go in with a higher position size. Those are the things that you have to note. If you have good risk management, I mean, good psychology, knowing that the outcome of this trade is going to be random, there will be no reason for you to use a heavy lot size. Now, McDonald says that when you want to enter a trade, right? It's like flipping a coin. You see, let's say 50 francs coin and you flip it, right? You actually don't know. I mean, you will not be so much certain that it's going to drop with this other side because you personally, you know that the outcome of flipping this coin is going to be so much random, right? So McDonald's training your mind to think like that. Then it says you should, that means you should try when you want to take a trade, think of it like flipping a coin, right? Trading is not flipping a coin, but here this exercise is to help you to be able to control your risks, or is to control your risks in the trade. Okay, think like you're flipping a coin, all right, and you know that the outcome of flipping that coin is going to be random. So you should have that mindset when you are doing trading. It's going to help you to use good risk management. Okay, so guys, that is it for our risk management and psychology lessons. Okay, for this phase 9, we are going to host for a session for questions and answers on this risk management. And then we're going to be going up to phase 10, which is the last phase. We're going to do some top-down analysis. I'm going to choose a pair that we are going to do some top-down analysis on it, and then we put the things together, right? I mean, we should walk through the whole process of the things together, okay? So anticipating for this lesson 2, now I'm going to be signing out. Thank you guys for your time, and I wish you good trading.